Navigating the Labyrinth. An introduction to banking regulations. The banking industry operates within a complex web of regulations. These rules are designed to ensure stability, fairness, and transparency. Banks must comply with these regulations to maintain their licenses and operate legally. This intricate regulatory landscape can be challenging to navigate. However, understanding the underlying principles is crucial for success in the banking sector. Regulations impact nearly every aspect of banking. This includes capital adequacy, lending practices, and consumer protection. Failure to comply can lead to severe consequences. These consequences can range from hefty fines to reputational damage. In extreme cases, non-compliance can even lead to the closure of a bank. The financial crisis of 2008 highlighted the critical importance of robust regulation. It exposed vulnerabilities in the global financial system. This led to a wave of new regulations. These regulations aim to strengthen the resilience of banks and prevent future crises. Understanding and adapting to this evolving regulatory environment is an ongoing challenge for banks of all sizes. It is essential for maintaining a stable and trustworthy financial system. Thank you for watching this video by Ace Capacity Training. Keep watching our videos for more insightful ones.
A world of rules, local and international regulatory frameworks. Banking regulations exist at both local and international levels. Local regulations are specific to the country or jurisdiction where a bank operates. They cover a range of areas such as capital requirements, lending limits, and consumer protection laws. For example, in Ghana, banks must comply with regulations set by the Bank of Ghana, which oversees the financial sector and ensures stability. These agencies oversee different aspects of banking operations and work to ensure the safety and soundness of the financial system. International regulations, on the other hand, aim to harmonize banking practices globally. The Basel Committee on Banking Supervision is a key international body that develops standards for banking regulation. The Basel Accords, established by the BCBS, provide a framework for capital adequacy and risk management that are adopted by countries around the world. The interplay between local and international regulations creates a complex web of rules that banks must navigate. Banks need to stay informed about changes in both local and international regulations to ensure ongoing compliance. This requires dedicated compliance teams and a proactive approach to regulatory change. The fight against financial crime. Understanding anti-money laundering. Anti-money laundering policies are a crucial component of regulatory compliance in the banking sector. Money laundering is the process of concealing the origins of illegally obtained funds by passing them through a series of complex transactions. Banks, as gatekeepers of the financial system, are on the front lines of the fight against this criminal activity. AML regulations require banks to implement measures to detect, prevent, and report suspicious activity that may be indicative of money laundering. This includes verifying customer identities, monitoring transactions for unusual patterns, and reporting suspicious transactions to relevant authorities. Effective AML programs are essential for protecting the integrity of the financial system and preventing criminals from profiting from their illegal activities. Banks that fail to comply with AML regulations face serious penalties, including hefty fines and reputational damage.
Section 4. Knowing your customer. KYC policies and their role in compliance. Know your customer or KYC policies are another cornerstone of regulatory compliance in banking. KYC regulations mandate that banks verify the identity of their customers and understand the nature of their business activities. This helps banks assess the risk associated with each customer and develop appropriate risk mitigation strategies. The KYC process typically involves collecting and verifying customer identification documents, such as passports or driver's licenses, Ghana card, and gathering information about their source of funds and business activities. Banks also use ongoing monitoring to detect any suspicious activity in customer accounts. KYC policies are crucial for preventing financial crimes such as money laundering, terrorist financing, and identity theft. By understanding who their customers are and their financial activities, banks can play a vital role in safeguarding the financial system from illicit activities.
Section 5. Building defenses. Strategies for effective risk mitigation in banking. Risk mitigation is an ongoing process in banking. It involves identifying, assessing, and managing potential threats to a bank's financial stability and reputation. Effective risk management requires a proactive and comprehensive approach that addresses risks from various sources, including credit risk, operational risk, and compliance risk. One key strategy for risk mitigation is diversification. This involves spreading investments and loans across different asset classes, industries, and geographic locations, reducing the impact of potential losses in any one area. Another crucial aspect is robust credit analysis. Before granting loans, banks must thoroughly assess the creditworthiness of borrowers to minimize the risk of default. Banks also implement sophisticated risk management systems to monitor and control their exposure to various financial risks. These systems use advanced analytics and modeling techniques to identify potential vulnerabilities and support informed decision-making. Regular stress testing of portfolios helps banks assess their resilience to adverse economic conditions and identify areas for improvement in their risk management practices.
Section 6. Empowering your team. The importance of comprehensive compliance training. Comprehensive compliance training is paramount in equipping bank staff with the knowledge and skills to navigate the complex regulatory landscape. Employees at all levels, from tellers to senior management, must understand their role in maintaining compliance and mitigating risks. Effective training programs cover a wide range of topics, including AML and KYC policies, data privacy regulations, and ethical conduct. Interactive training methods, such as case studies and simulations, help employees apply their knowledge to real-world scenarios. Regular updates and refreshers are crucial to keep staff informed about new regulations, emerging risks, and best practices. A well-trained workforce is a bank's first line of defense in ensuring compliance and managing risks effectively. By fostering a culture of compliance, banks can minimize their risk exposure and maintain the trust of their customers and regulators. Thank you for watching this video by ACE Capacity Training, ACT. Keep watching our videos for more insightful ones.